Hi folks, we're going to go through a short video here going through the various different details of a term sheet. Hopefully you've watched the two other shorter videos, the YouTube videos about term sheets. They give you some good overviews, and what we're going to do here is actually go through a real term sheet from High Peaks Venture Partners. So I want you to follow along with that detail. So in addition to this video you're watching, in Moodle, just below where you clicked on this, there was a thing that said companion term sheet to go along with this. If you click on that, and if you can either be watching that on a screen so you can follow along, or if you can print it out, have it in front of you, that would be very helpful, because that has a lot more words in it than I have on these PowerPoint slides. So I'll give you a few seconds to get that ready and get that set up. So hopefully in front of you, you have the top page says term sheet for Series A investment in the company, Inc., December XX 20XX. The name of the file is Elements of a Term Sheet. And I shared that with you, hopefully via Google Docs. And so get that in front of you, and then we'll dive in. Okay, so the first paragraph that we see there is basically the important element of that is no shop and confidentiality. That means if you're the company, so a term sheet is typically presented by the investor. So the VC in this case would present this term sheet to a company, and it would be after the result or would be the result of several conversations they have had and probably a fair number of meetings. And this is the venture capitalist way of it saying, hey, if we think we want to make an investment in you, this is not binding, but we think we want to make an investment in you, and here's sort of the terms that we're thinking about. And there's still a whole bunch of ifs, ands, or buts that go along with this, but it fundamentally is saying, it's like getting engaged, I guess, is the best way to say it. And as part of that, what the venture capitalist firm does not want the company to do is to go take this term sheet and shop it around, meaning go to other VCs and say, hey, look, I got this offer at a $3 million pre from High Peaks. Can you match it or give me a better one? So that's what the no shop means. And the confidentiality is similar to that. It's saying you're going to keep the terms of this term sheet confidential between the company and the investor, or in this case, High Peaks. So that is pretty important. It's in every term sheet. No shop, no shop and confidentiality. So that should be pretty straightforward. So now there's a couple of other terms we're going to go through here. Hopefully you're still following along in that document. The closing date. This just basically says this is the day that we're going to sign all the documents and the money's going to end up in your bank account. And we're saying it's approximately 30 days once the company signs the term sheet and the conditions to closing have been met. And so that's pretty easy. It says the investors in this case are High Peaks Venture Partners, and they're going to invest $600,000. And that other investors may invest up to $600,000 as long as those other investors are mutually agreed to by High Peaks Ventures and the company. So this investment ranges from $600,000 to $1.2 million. And that's typical. In this case, High Peaks would be called the lead investor because they're the ones sort of defining the terms. And the other investors would be the follow-on investors. So that's very typical that VCs invest in groups, not individually. I think of the 40 plus investments we've made at High Peaks, only 2 of them were we the solo investor in. In all of the other ones, we partied with or joined with other VC firms. Sometimes we were the lead investor, sometimes somebody else was the lead investor. So that's what that means. In this case, the next term is security. The security is Series A preferred stock. That's just giving it a name. Series A just means it's the first set of preferred shares. If there were a year from now, if there's another investment, that would probably be called Series B. And if some period of time after that one, there's another investment that would be called Series C. It's just a way of identifying the various different investments. The total maximum amount is $1.2 million, like we said above. So it's going to range from a minimum of 600 to a maximum of 1.2 million. So that's pretty straightforward. Okay, now we're getting into the price per share. So the price per share is calculated, and so it's often not stated in the term sheet because we might not have enough information. But what's more important here is the pre-money valuation, because the price per share is a result of a calculation driven by the pre-money valuation. So the pre-money valuation sort of determines what the price per share is. And the pre-money valuation in this case is going to be $5 million. So that says fully diluted pre-money valuation. So that means it's taking all of the granted and ungranted shares and options that the company currently has, and that's going to be that's what it's based upon. So at $5 million, if you had 1 million shares total in the company, each share would be worth $5. That would be the price per share. So that's just sort of how this works. And here, this is just saying that it includes all of the shares. Sometimes the shares in a stock option plan get excluded from this. It's to the venture capitalist advantage that they get included, so that the venture capitalist is not getting diluted, and that the investors, the original shareholders, are getting diluted and not the venture capitalist. So that's just a little minor point here. You can negotiate it, but it really doesn't make that big of a difference. But most VCs are going to insist that it be the fully diluted pre-money valuation. In this case, $5 million. We're going to talk later about how you determine the value of a company. It's more art than science, and but it's a very important number. So the next term here is capitalization. Capitalization is you saw a sample of that in the that example we did last week, I think it was, or no, not last week, and earlier in this week, where we did the investment. You started a company with your getting money from friends and family, your uncle and your mom and dad and grandpa. And remember that table we had there that showed the percentage ownership of each person? That would be a capitalization table. So the cap table is really important. That lists who all the official shareholders are, and that's really an important element to have in any term sheet, because that's sort of the legal record as to who owns shares and how many there are. And certainly you don't want any surprises in that regard. So these are some pretty key elements here. The one that really gets negotiated the most is this pre-money valuation. That's what everybody argues over. Certainly the VCs don't want that number to be high, and the founders want that number to be high. So that's the negotiation that goes back and forth here. Okay, we're going to talk about dividends. So almost every investment in preferred shares done by an institution like a venture capitalist or other private equity firm is going to carry a dividend with it. This is not a cash dividend. It's a dividend where just a number of shares accrue. And usually that dividend interest rate varies from 4 to 6 to 8 to maybe 10%. Sort of depends a little bit on what's going on in the marketplace, how attractive the investment is, but it's fundamentally a sweetener for the venture capital firm to up its investment without putting any additional money in. And one might say, well, wait a minute, why do they get it? Well, they get it because they have the money and they can demand it. If there's a 3 or 4 or a half dozen VCs lined up at your door wanting to invest, you could probably negotiate a term sheet that doesn't have any dividends in it. So part of this is a true indication of supply and demand. But most of the investments I've seen and have participated in all had some sort of dividend associated with them. So the next thing here is liquidation preference. Liquidation preference is very, very, very important. It's very important to the investor, and it's even just, if not more important to you, the founder of the company. So this we should really focus on a little bit. So liquidation preference fundamentally says that when there's an exit of the company, this is how the proceeds get distributed. So this has what's called a 1x liquidation preference. If you read that second paragraph, it says first pay 1 time the original purchase price. Okay, so this says pay 1 time the original purchase price plus accrued dividends, we just talked about the dividends, on each of the Series A shares. So that means if I, the VC, invested $600,000, and let's say we sell the company for $1 million. Didn't go really great. We just sell it for $1 million. So we're going to take $600,000 right off the top of that $1 million, and it's going to go back to that investor. So they get their $600,000 back, and now there's $400,000 left in the pool. And now that pool is going to get divided up amongst all of the shareholders based on the percentage ownership they have in the company. So here again, this is a way for the VC to kind of front end load their return. And you can see here that it says that once it hits 5 times their original purchase price, so let's say we sold the company for 20 million. We sold the company for 20 million, and the pre-money valuation was 3. That means it was like a 6x return, approximately. And so that means the VC made more than 6 times their money, or in this case, the VC made more than 5 times their money, which is outlined here still in that second paragraph, third line from the bottom or fourth line from the bottom. And if the VC is making more than 5 times their money, this liquidation preference goes away. So then you don't take out that $600,000 first. Now you might say, well, geez, this doesn't sound very fair. Well, this is in there to protect the VC if things do not go as planned. Because the fundamental agreement here is the VC is writing you, the founder, a check for a certain amount of money, and you, the founder, are saying, hey, here's our business plan, here's what we're going to achieve. And if you achieve that, all is good. A lot of these terms in here actually sort of go away. But in this case, if it doesn't get to 5 times, then first they're going to take out their liquidation preference, their 1x, one time of what they put in, and then share everything else with everybody thereafter. Some liquidation preferences are 1x, like this one is. Some are 2x. I've seen liquidation preferences as high as 5x. So you really want to pay attention to this, because you can end up in a situation where the common shareholders, i.e. the founders and the employees, have no money left over for them once the proceeds are divided up. So the next one here is voting rights. Those are really important as well. Voting rights are sort of tells you how things are going to get voted on. In preferred shares, sometimes preferred shares might get 2 votes for every share of common stock. So someone who owns preferred shares can vote 2 votes for every 1 vote that a common shareholder has. This section also states that the Series A preferred shares shall get to elect 2 members to their board, and they get to elect 2 members regardless of how many shares they have, and that's really important because people on the board sort of get to make decisions. Most of the votes and decisions happen at the board level. So this says that they get to elect 2 members of the board. I think later on in the document it defines how many board members there are, and I think it's 5. And the Series A folks get to elect or select 2 of those people. Now, this is also a very important element here. They're called protective provisions. And one way to think about this is this gives the preferred shareholder power or control over the company that's disproportional to the percentage of ownership. So oftentimes you hear people say, well, as long as I own 51% of my company, I'm in control. That's true if everyone owns common shares of stock. But here, you're getting preferred shares of stock, or the investor is getting preferred shares of stock. And along with that, they're getting some additional rights, like the dividend we talked about, like the liquidation preference we talked about. And here it says that as long as 20% of the Series A preferred shares are outstanding, meaning if I bought 100 of them, as long as I own at least 20 of them, then the company will not written consent of the holders of at least 2/3 of the company's Series A preferred shares. So this means that 2/3 of the people who own Series A shares have to approve the company doing any of these things. So that the things that it needs to approve are liquidate, dissolve, or wind up the affairs of the company. So liquidate would mean sell the company. Dissolve would mean go bankrupt. Or wind up would just mean close the company, or any other merger or consolidation. Amend, alter, or repeal any provisions of the Certificate of Incorporation or bylaws. The Certificate of Incorporation and bylaws has all of these things in this term sheet in it. So that's really the governing document for any company. And so the company cannot change those, any of those, without the expressed written permission of these Series B shareholders. They cannot create, authorize, or issue any other securities, so they can't sell any other shares of stock without the permission. And let's see, what else is there? They can't pay a dividend. They can't go into any debt greater than $100,000. And they cannot create or hold capital stock in a subsidiary. So that means they can't buy something else. So the reason these things are in here is the venture capitalists are trying to protect their investment, and they want to have some say over what these things do. And even though they might have 2 seats on the board, they're saying for these particular things, and these things in this list are pretty major things for a company, they have to get approval of the preferred shareholders. This is very common. It's in most deals or term sheets, and you can do some negotiating on it, but it's there to protect the VC. So it's very, very common and happens a lot. So let's see, what's optional conversion? So optional conversions basically says that the Series A can convert to common whenever they want. And sometimes there's advantages to that. Sometimes there's tax advantages. Sometimes there's other advantages. But it's basically saying, you know what? They convert 1-to-1 whenever they want. And now, that's not a big term. Doesn't happen very often, but it's in there. Now, here's another big one, anti-dilution privileges or provisions. This is really big. So what this is saying, the simplest way to explain this is, let's say for this $600,000 investment, just to keep numbers easy, I paid $1 a share. So I invested $600,000. I got 600,000 shares. And let's say a year from now, We ran out of money. Things are not going great, and we can't get a pre-money valuation as high as the last one. So that means that let's say we're going to have to sell shares at 75 cents a share, which would be called a down round. In other words, the price of this round, a Series B, let's say, is going to be 75 cents a share, where the Series A was $1 a share. Well, what the anti-dilution says is you're going to take all of my shares, all of my Series A shares, and if I had 600,000 of them, you're going to issue me more shares as if I would have paid 75 cents a share for them. So I'm going to end up getting more shares. So fundamentally, if the price goes down, one way you can think about it is, it's a price match guarantee. If somebody pays a lower price, I'm going to get it, and I'm going to get changed into that. Very common anti-dilution. There are various different flavors of anti-dilution. Some are full ratchet, some are weighted average, etc. It's a minor little tweak, but the fundamental concept is the same. So again, anti-dilution is very, very common, and it's in almost every deal. And it's basically a way, again, of protecting the VC. If things don't go like they're supposed to, they get down round pricing protection. Mandatory conversion is just basically says if and this was actually in the liquidation preference as well, or a different version of this. But if I'm getting back more than 5 times my money, all of my shares just convert to common shares. So that's not a biggie, but it's in every deal, and I just want you to be aware of it. So let's go on to the next slide. So redemption rights. Redemption rights basically says that if this company's kind of chugging along and no one's interested in buying it, and we're not big enough to have an IPO, that after 5 years, I think that's what this says, 5 years, I can start to redeem some of my shares of stock. So I can say, hey, start buying these shares of stock back from me. This is not a good deal for anyone. Nobody wants to do this. And it's a right that is in every deal, but it's very rarely exercised because a shareholder cannot force the company to go out of business. So for example, if you owed us $600,000, but you only had $300,000 in the bank, I can't force you to liquidate the buildings and stuff to pay back my shares of stock. So it's sort of a weird term, but it's in there. But sometimes you have companies that are chugging along, they're spitting out cash, they're doing quite well, and this is a way for the VC to be able to get paid back. It's nobody's preferred way, but it is a way to get paid back. Okay, reps and warranties. This basically says you're going to go through, there's going to be a whole bunch of documents, and those documents are going to say all sorts of things, such as things that'll be in the reps and warranties are your financial statements are true and accurate. You have employment agreements with all of your employees. The intellectual property that you say you actually own. So it basically says all of the things that you have told us are true, and there's no hidden skeletons in the closet. So there's a standard list of these things, and the lawyers sort of go to town on these things. And this 5 or 6 page term sheet probably gets turned into about 300 pages of legal documents at the closing. That's what the lawyers get paid for. And it's just the reps and warranties are in every one. It just basically says what you're telling us is true and accurate. Closing conditions. In this particular deal, we said that this is unusual, but I will put it in here just to tell you that each one of these can be very unique. This company said that they were on the brink of signing a big deal, a big sale with another company, meaning selling their product. And what we said was, okay, we believe you, but that we're not going to close. We're not going to write our check to you until that contract with the other company is signed. So we wanted that in writing and a signed contract, not just a promise that something will happen. So that's what the condition to closing is. Sometimes there can be all sorts of conditions to closing. Sometimes there's none other than the reps and warranties. But in this case, we had some very specific things there that you can read about in the follow along companion document that talk about price per widget. So it's pretty specific. And then the last thing is counsel and expenses, which this basically says the company is going to pay for all of the attorneys, but it's not going to exceed $35,000 in expenses. So this also is very common. The company ends up paying for the VC's attorneys and their own attorneys to get the deal done. Okay, well, we're going to stop here. In the companion document, the actual term sheet, you can see we're just on page 4, and there's a whole bunch of other things that follow, which is called the Investors' Rights Agreement. You're welcome to read that over. I'm not going to go over that because it's not super important. Many of the things in there are sort of details to some of the things we've already talked about, but I did want to make you aware that these are long documents, and like I said, this will get turned into 300 to 400 pages of stuff for the final closing. So another thing I did want to share with you is that there's an organization called the National Venture Capital Association, NVCA.org, and they have a standard set of term sheets that you can download. So the VCs, that's sort of the VC industry organization, they have gotten together and put together sort of best practices in term sheets. They update it once a year, and oftentimes that's a good place to go as a start or as a comparison to terms that are sort of what's the latest going on in the industry. So that's very helpful as well. So again, that's nvca.org. And I hope you found this informative and interesting. These term sheets are an absolute critical part. It's basically defining the agreement between the VC and the company, and they're really important. So if you have any questions, again, as always, feel free to post them into the forum, and I will answer them as soon as I can. So hope all is well and you're enjoying the course. Thank you very much.